Welcome to Stay in Touch, the podcast that unpacks the complexities of financial plannings and programs. Join us as we explore the options available to you to have a better financial future. I'm your host, Mariana Villarreal, and each week I'll have an expert in the field that is going to give you information and knowledge to help you plan the best future that you can. Whether you're a small business owner, head of household, or just a little bit curious, Stay in Touch is here to empower and educate our listeners by debunking some myths, some misinformation, and we will cover a wide range of information for you to have a better plan for your future. So sit back, relax, and enjoy the show. Welcome back to Stay in Touch with Mariana Villarreal. Today, we're bringing back our first guest, the CEO, President of InTouch Financial Group, Izquierdo. Thank you for taking the time to be with us today. I feel like we needed to bring you back to give you some kind of street credit. You know, you're not just the owner, you worked in the business for many years, and then you've evolved just from going from life insurance to so many more avenues because of how diverse life insurance is, you know? So I wanted to bring you back to ask you a little bit more on, most people really are looking for some kind of investment avenue, but is also protected, and they're scared from what people say about, index universal lives or whole life insurance policies where it's something permanent, but there's so much more that you could do with it. You know what I mean? So I know that you've been in the industry, so you've seen it evolved quite a bit.
Yeah.
It's changed a lot.
It absolutely has. When I first started out selling life insurance, the biggest component, the biggest vehicle we had for cash accumulation products were traditional whole life products. Mm-hmm. So, the way those products kind of accumulate their savings is through either a dividend option from a mutual company or some kind of fixed interest rate. So, it was a challenging sell at that time, to kind of pitch life insurance as a true savings vehicle. I mean, the life insurance component itself has great tax strategies behind it, like the reason we use life insurance. But, when we were selling at that time, it was a little challenging competing against, a true, stock product, mutual product, or an interest-based product at that time.
Yeah, I think right now everybody's kind of looking for higher interest rates, mm-hmm. like returns. Mm-hmm. I mean, banks have upped it up from 1% to now some saving accounts are giving you 5, 6, depending what you can find and what you qualify for.
Right.
So when it comes to index universal life products, why would somebody pick that over a whole life insurance?
So, a whole life product is a form of a permanent life insurance product, but typically the way it works is as a traditional form of life insurance, you have, your cost of insurance that is broken out into the premiums over, whatever the time of purchase to mortality is. Mm-hmm. And then you have the rest of those premiums going into let's call it a bucket, that is earning either an interest or a dividend option. That's how a whole life traditional life insurance product would work. With Index Universal Life, it has kind of the same makeup, but more options available to that consumer, to that client, as far as when it comes to, saving opportunities. So I kind of go back in time to like when we were selling life insurance when I first started. And the biggest phrase that we always heard from our clients, from our competition was buy term and invest the difference. And one of the biggest reasons when I look back at it, why that was because traditional whole life insurance, you may have gotten 5.5%, close to 7% when that dividend option was paid out. And when I started selling life insurance, that interest or the S&P or, whatever it was you were investing into was at a much higher rate of return than that. So when you're thinking of it, even with the tax implications behind those two vehicles, the rate of return was still higher buying term, investing the difference. So as an industry, there's been an evolution of how to kind of still have the tax benefits of life insurance, but, have the returns that our clients are wanting. So you've had things like, your first universal life policies, they were all interest based. And when the interest dropped and these policies were underfunded, clients were losing money, losing their policies. So we had to change from that standpoint. Then you had VUL, a big push with variable universal life. And when the stock markets did bad there, that's kind of when the evolution of index universal life came about. Mm-hmm. And I think it's the best format available for somebody to kind of at least get a big majority of their savings in play. I'm not saying that 100% of it needs to be there, but it's a great vehicle for making sure that I have money growing tax deferred. I have, money in the future that I can pull out tax free. But then, oh, by the way, it's a self-completing plan that if I die unexpectedly before the day I want to retire, my family, my spouse has this other bucket of money available to them. So, I think everybody involved in the life insurance industry finally got the mix right, as far as being able to benefit from the tax thresholds that come along with it, but also keeping it still a life insurance policy by having an index universal life.
Yeah. And I think a lot of people might be a little bit scared because they hear, oh, it's a product from a life insurance company. And then when I think about it, I'm like, if something was secure enough, it would be a life insurance policy, because if something were to happen to you, that there's a contract that it's legally binded that this has to be paid out, and you trust it the most when you're dead. So, because you're going to make sure like your family is well taken care of. So if you're going to trust it, buying a term to make sure that your family is getting paid the money that you're basically agreed to, why not use it while you're still alive?
Absolutely.
Yeah. And so I think just the whole word of life insurance is scary, especially like, oh, well, just put it in Bitcoin, put it in some crypto.
And how risky are those things?
Yeah, exactly. So I think maybe when it comes to younger people with no 401ks, and there's a lot of, self-employed, they are not putting any money towards their Social Security. Like I looked at my Social Security account the other day. I'm a little sad because it shows that I have not worked in the last 5 years because I am a 1099. So I got to kind of figure that one out. But in the back of my head, I'm like, okay, yeah, I haven't been contributing to Social Security, but I do have a index universal life that is growing that money for me for when I do retire.
Right.
Based on our clients and, the age groups that we have, we're very diverse when it comes to our health insurance. Who would you suggest for them to look into maybe an IUL, like what age range? Because I feel like if you're too old, it doesn't give you enough time.
Yeah, I would say the sooner the better. So if you're working and looking to contribute towards some kind of retirement future, the sooner the better. But really the way the product works, you need to have at least 11 years, 10 to 11 years to kind of see a true benefit of that cash accumulation. So it would all depend on what target age you're looking at for retirement. So if you're 65, maybe we call it 54 years old would be kind of that last look at what I look at to really get a maximum out of the overfunding an IUL policy. It doesn't mean that an IUL doesn't help that person, but for the purpose of cash accumulation, it might not be as advantageous as starting earlier than that. So that's kind of how I would look at it. But, when you look at how long people are living now, right? I mean, insurance companies a few years ago moved mortality from 100 to 120. Maybe there isn't a wrong time, right?
Yeah.
Like whatever you've done up to this point to kind of protect yourself for retirement might help you get to that point where your IUL can kick in, So I guess the mindset needs to be that this isn't a lottery ticket that, you buy one premium, you're $1 million richer, right? You can't, numbers are numbers, but you've got to understand that you've got to look at this from at least 10 to 11 year down the road view. You can't look at it as, in 5 years, I could start pulling money from this.
Yeah. So I'm pretty sure people are asking, are IULs expensive?
That all depends on your age. Again, IULs are underwritten on our chances of dying or any kind of health issues that we would have. So, if you're looking to contribute $100 a month towards a retirement savings, obviously there's going to be some cost of insurance involved. And depending on your age and depending on what kind of health issues you may have, that $100 would then go towards that particular column of cost of insurance. And the rest would then go towards the accumulation side, which, a lot of these companies now, and, National Life being one of our biggest partners, have several different types of funds that you can be able to choose and allocate to kind of put that in there. So, for me, it's just having an open mind and understanding this isn't, one of those quick get rich quick schemes.
Yeah.
Okay. You got to have a long-term view on this. And if you do take that approach, then, it will work out for you, because there also is different riders with these companies, right? Like guaranteed lifetime income riders and things of that nature. So, maybe there isn't a wrong time. If you're looking for it to kind of kickstart right with the day you want to retire, and retirement age is 65, start before 54.
Yeah, because there are some people that are always wondering, how do I borrow against my IUL?
They set it up from from the definition, from the term standpoint, as a loan against your cash value that you've accumulated. And that's really what makes taking income from that particular policy tax-free, because loans are not taxable. Okay. But at some point that loan does get repaid. And that repayment of that loan is either paid with additional premiums or on the death benefit once you pass.
Okay, because there's some people that call and they're like, hey, I want to get an IUL for, let's say, $300,000. How much is my premium? Cool, I'll get it. But can I borrow from it in a month?
Yeah, it doesn't work that way. Unfortunately, it doesn't work that way. Because I think the misconception is they feel they're borrowing from the death benefit, and that's not the case. You're borrowing from a bucket of money that you've accumulated over time that's also been compounded with whatever vehicle you've chosen.
Okay, when you mention vehicle, what kind of car are we talking about?
Not car. I should say whatever index strategy you've chosen. Okay.
Yeah. So. The people are going to be like, so what are we driving? No. Okay, so for people that are trying to use this as a fast cash, definitely not it.
Not it.
This is a long-term commitment. Mm-hmm. Now, let's say 20 years down the road, they're 30 when they start. And then at age 50, they're like, I don't want this anymore. Can they back out?
So there is the opportunity to back out, but there are tax implications with that. Because once you surrender the policy, then there's no longer that loophole of taking the money as a loan that makes the income to you tax-free. You're now surrendering it. There are some portions of that cash accumulation that may not be taxable, which would be considered like your principal, whatever you've contributed, that money's already been taxed. But anything that has grown from that standpoint would be taxable.
Okay.
So I always encourage everybody to at least leave 10% of their accumulation value in play, or lower their death benefit enough to kind of keep that policy in force if you took everything out, not to completely surrender the policy.
Okay. So do most people pick an IUL for permanent life insurance? Because most want something permanent. Maybe they don't like the fact that terms are only 30 years, but they like the fact that they'll have, some people, like some policies that I've seen that I've written, they're like millionaires by the age of 80 on the life insurance policy.
Right.
I mean, my parents, I told them, I'm like, hey guys, like I'll pay your retirement. Just make me the beneficiary. Don't touch them, because of how come the life insurance part, the death benefit grows as the cash accumulation grows? Why is that?
So that again goes to the part of the universal life component of this, that in some cases they either chose like an option B, which the cash value increases the death benefit, or the amount of cash within the policy needs for that death benefit to be at a much higher rate because of certain tax rules. But that's normally the reason why.
Okay. Yeah, because I've seen some people tell me, I don't really care too much about the cash accumulation. I'm doing other stuff on my own. Mm-hmm. But they do ask some questions of like, well, why is my death benefit starting year one at, let's say, $150,000, and then by year like 65, like once they're ready to retire, it starts to grow a lot. And I tell them, well, you see this, your cash accumulation, the interest rate has grown, so life insurance has to be higher than that one. Now, for those that are scared of outliving their money, do you think this would be a good idea for them?
Well, keep in mind with the Index Universal Life Policy, there are riders already embedded into this, attached to it, that provide them with the opportunity to have what is called a guaranteed lifetime income rider. So even if that account goes to zero and they live to 150, let's just say that, health is going to be something that, we have a better hold on. That account will continue to pay them whatever that lifetime income rider was supposed to be.
Okay. Yeah. So, I mean, I feel like some people are a little bit scared of that,
right,
outliving their money, especially in today's economy. It's quite scary.
Yeah.
So, all right. So one last question for you, for maybe the people that have been thinking about it, and how would they want to calculate in their head, this is how much I should be putting away? Or I always tell them, it's not like your traditional life insurance where it's kind of like just a payment. And if you use it, I mean, great and not great. Hopefully you don't use it, but it's there. Mm-hmm. So it's a lot cheaper to do a term. But if they were to really want to have something that's doing a little bit, like their payments are doing more, and they do this, what's the range? Or like, how would you tell somebody to calculate how much they should be putting into an IUL?
So I always try to correlate it back to their, their what they've gone through with their 401k at work, right? And typically people think of it in the sense of, my employer matches me at 3%, so I'm going to go up to 3 or 6 or whatever percentages that is. And I always try to correlate it back to that first. So if we were at an employer, Mariana, and you were looking to contribute towards your 401k, what percentage would you select when you were doing your annual election? Would you do 3% or 6%? And 3% is where they match. Do you want to do more or less? And you would then give me an answer, and based off of our fact find, I would be able to calculate for you at 3% of $100,000 a year, then you need $3,000 annually towards this IUL to kind of match that same contribution that you're doing. Right. If at that point they tell me, I'm not sure if I can comfortably afford that, which, in my mind, you were comfortably able to afford it when it was the 401k, then I kind of take them back to, well, if we were to start a traditional IRA for you, you would have to, at a minimum, to keep that status, do at least $1,000 a year, which is about $83 a month. So between $83 a month and your 3%, what is a comfortable range for you, for me to run some illustrations for you on? And that's kind of how I walk them through it.
That's a good way. Yeah, because I think right now, everyone is trending the whole Roth IRA. Mm-hmm. But because of inflation and salaries going up, most people don't even qualify for Roth IRAs because of the $125,000 125,000?
I have to double check the numbers on that, but I believe it's 125,000 for individuals, and there's more for married couples. And the reason why that's so popular is because when they pull that money out, that money is income tax free. So, and when I first started hearing about IUL, it was like, the Roth IRA on steroids, because there is no maximum cap that a person can contribute to that other than what the underwriters say for your age and income.
Yeah, so I guess people should just shop around, see what is available in the market, what suits them best. The Alliance Group has this really good video. I think we should post the link of how it explains IULs in these little cartoons. I always share that video whenever I come across it. But, IUL, I swear by it. I tell everyone that I can, you have to look into it. You have to look into it. Like, do your own research. There is a lot of biased YouTube videos that you're probably going to see that say, stay away, don't do it.
And my opinion on that is take a look at what they're trying to sell in competition to that. And that's why their videos exist. When you look at, banks, one of the old previous chairmen of the Federal Reserve, they have about 60% of their assets in vehicles like this, not cars. Okay. Investment products in a life insurance type of product. So if these people that are, quote unquote, handling all our money are doing 60% of their assets into that, then why would it be a bad product?
I don't know. It's just bad information out there circulating, and most people don't do their research. They just go with the flow. I mean, we do have a lot of sheep in society. We need a lot more like, hey, you know what? I see where you're going. I respect your opinion, but let me just do a little bit more research. And I think that was the main reason why we started this podcast, was to explain a little bit more about what we do and what options you have with something that you might have not really thought about it. And so it kind of like eases you a little bit more. So if you're interested in seeing some kind of quotes, we'll name them quotes, just so we can get some reports out to you about where you would be if you were to invest $100, $200, $300 a month towards an IUL to secure your future a little bit more. I always tell my friends, do a combination of both. See how much you were really wanting to do, like invest in your future for retirement, and then just split it. Give me half, let me do what I do, and then do the other half somewhere else. And then by the time retirement comes, you're going to be like, damn, Mariana, I should just put it all with you. And be like, I told you so. I
think right now it's very important for that type of information to get out there. I mean, we're really living in that pensionless generation. Most of our parents or grandparents work somewhere that when they put in enough time, a pension would kick in to help take care of that. You have your political concerns of, is Social Security going to be around? Since COVID, far less companies are contributing towards a 401k or even offering a 401k. So it really is time for you to kind of have that self-security and make sure that you plan for your retirement, because if you don't, nobody else is going to.
Yeah. And I mean, I think there's a lot more 1099 employees now because everybody is trying to boycott corporations, that balance of work life. It's hard to have working for a large corporation that does have those things maybe as like, oh, you should work for me, I'll help you in the future.
Right.
But right now I need you to basically give up your life for me. And so there's a lot more of like at least my age in their early 30s that are just trying to break free from corporate world and start their own businesses. But doing that, you focus too much on right now and you kind of put your future, your older self in the back burner. And then once you get to that age where you're like, hold on, I'm like 10 years away from it. Right. What did I do? I mean, I'm hoping everybody's small businesses grow to where they can have that residual income coming through. But it's also good to have plan B, C, and D, some kind of incomes from all different avenues, so that way you can retire peacefully and not be a burden to either your kids or, I mean, in my case, I'm not having kids, so I need to make sure it's on the right path. So thank you for taking time to talk to us a little bit. Maybe next time we should have like an example of like a 30-year-old starting it. I mean, babies can even start it, right?
Absolutely, yeah. After 18 days of birth, or is it 15 days? I've got to double check that. They can be able to start a plan right now.
Yeah, so instead of using like a Gerber Life plan, you could use an IUL for your child and set them up for success when they retire. It's called $1 million baby or something like that.
That's a concept that how we used to phrase it, but you know, we try not to label it that anymore, even though by the time the person uses all of their accumulated cash, it pretty much works out to them accumulating up to $1 million, you know, by the time
you're ready to retire.
Ready to retire, yeah.
Yeah, so I mean, if you're not looking for options for yourself, look for the options for the people that depend on them.
Yeah.
So their kids,
And I think it'd be good to kind of share. These products are used for more than just retirement, right? It's any kind of accumulation idea can be used for this product. So saving for a child's college education or paying off a mortgage sooner than whatever your term rates are. I've seen it used for like financing missionary work or helping churches do expansions down the road. I've seen it used for pretty much any kind of accumulation idea. So, you know, it's not just limited towards retirement.
Okay. Yeah, I've seen it mostly for retirement, but that's good. I didn't know you could do all that.
Yeah.
You see, this is why we're doing this. Knowledge is power. So thank you again.
Not a problem. Love being here.
Yes, and we'll get you on again, maybe some more in-depth, and we'll have like another part of the screen like showing us how to, you know, how you should read a report on an IUL for different ages.
Okay.
So that way people are like, if we are their only avenue of really knowing what an IUL is, I think they would really like that.
I think your plug on using the Alliance Group's links with the videos that Sam and Travis and all of them have put together here.
Yeah.
Those are excellent videos. I've used them personally with our clients and prospects, and they do a great job of explaining the way these things work and the advantages of starting early.
Yeah. But if you are interested in just running some numbers, doesn't take a long time. Like, the systems are so easy. I just input your information and then send you some reports and you can check them out, you know, see your options. My email's down below. Feel free to email me some information and I can definitely get you started at least in the right path, and then you guys can always make your own choices. But thank you again for tuning in, and we'll see you next week.